Hi, everyone. Thank you for joining Wisdom Tree's office hours on Where Will Global Central Banks Take the Markets in 2025, where you'll hear from Kevin Flanagan, Wisdom Tree's head of fixed income strategy, Jeff Weniger, our head of equity strategy, Aneeka Gupta, director of macroeconomic research, and Nitesh Shah, head of commodities and macroeconomic research.
Thanks, Irene. Hello, everybody. Welcome on both sides of the Atlantic Ocean for the Global Edge. We are going to discuss a lot about global central bank policy, what we see going forward, but obviously, with what occurred here in the US and the global reach that a red sweep, in other words, Republicans not just winning the presidency, but the Senate and the House of Representatives, what that could mean as well, right? I mean, because we hear a lot about tariffs and what influence they could have, say, in the Asian sphere of influence. So, a lot to discuss here on the policy front. So, a lot of macro, a lot of global central banks, a lot of fiscal policy. And, before I turn it over to the rest of the panel here, we did get one question that came in, and I kind of wanted to start off with that here in the US because it kind of combines what I said in my opening. The results of the US election and monetary policy here in the US. And we have been getting this question a lot, and it's more than likely due to the fact because the 45th president here in the United States was Donald Trump. So there is kind of a backstory because who was the Fed chairman at that time? Well, Jay Powell. Guess what? The 47th president is going to have Jay Powell as well as his Fed chair. So we have seen a lot of questions, not just here in the US, but on the global stage also. What type of influence will Trump try to inflict, for a lack of a better way of putting it, on the Fed? I think Powell seemed to be quite sensitive to that at the November FOMC meeting about 10 days ago, where he said if he was asked to resign, he would not. And there's a lot of misconception out there of what the US president can or cannot do with the Fed. Remember, the Fed chair, the vice chair, they are actually governors as well that serve a separate term, appointed by the president, confirmed by the US Senate. There really isn't much the president can do to change that. I guess you could try to impeach, or if there was a kind of scandalous behavior, perhaps things could get changed and you could make a move. But President Trump can't get rid of Jay Powell because he's raising rates, cutting rates, not doing what the president wants. Just doesn't work that way. And Powell kind of reiterated that from a legal perspective. There's really not much the executive branch can do at this stage of the game. What does that mean, everybody? It means we have Fed Chair Powell, God willing, health wise, till May of 2026. Before then, Trump would come up with a new Fed president, new Fed chair. One other thing on this note, and then we'll move the discussion on, is there has been some, conjuncture. Can Trump change the Fed? No, the Fed was created by Congress. Okay. So, in order for the Fed to be changed in any way, Trump cannot do it via executive orders or something like that. It needs to go through the legislative process. And there would probably be no appetite, even though the Senates have a somewhat of a better majority than what we've seen before in the Senate. And B, they're going to have a very, very slim majority in the House. So I wanted to kind of put that to rest because we get that a lot and start off the conversation of where we go from here and look at it from the vantage point. Jeff, I'll turn to you first, and then I want to get Aneeka and Nitesh in there. And since we started off on kind of the political aspect, the fiscal aspect of this, let's go to the big T word. And it's a question that we just saw, I think, come in on tariffs. Let's talk about
Yep.
tariffs a little bit, Jeff. So take it from there.
Yeah, and that one was from Steven. I see it on my screen here. It's tariffs are mooted as being inflationary. How will this impact the Fed lowering rates and knock-on effects with mortgages and so on? Now, on the matter of Jay Powell, which I believe is it's second quarter of 26, right, Kevin, where he his career as we know it will end, and then he'll go on the speaking circuit. Is that right? Second quarter of 26.
Yep. May 2026. And just, for the question coming in there, another important point that Powell has emphasized, not just at the FOMC meeting a couple of weeks ago, but also on Friday. The Fed is not going to base upcoming monetary policy decisions on what may or may not occur in Washington, D.C. The Fed is going to wait until whatever is proposed becomes actual law. It gets implemented, and the Fed can begin to see the signs of what it may or may not accomplish. So just because you may see tariffs implemented, increased, that doesn't mean the Fed willy-nilly is going to make any kind of shift in policy. They're going to wait and see. Any shifts in monetary policy at this stage of the game from the Fed will be determined on how the economic and inflation numbers are coming in, not what is perhaps envisioned in a more tariff-laden kind of policy from the U.S. So let's just kind of put some of those things to rest. But I do want to get to the point, Jeff, of tariffs for China, for Korea, for Japan, and then get Aneeka and Nitesh to weigh in as well.
Okay, well, Korea, I mean, the Kospi, if you bring up that one, I mean, the Kospi was trading up near 2,900 and is now in the mid 24. So you've had a breakdown in Korean equities in the last, jeepers creepers, eight weeks or so. It's been pretty brutal. And a lot of that is already starting to price that in. And that's what I want to ask Aneeka with the respect to how inflationary some of this is, a lot of these economies where, the S&P is at 5,800 or so, it's basically at all-time highs, but there has already been some comeback here or some retracements in some of these overseas bourses. You saw, for example, the Shanghai Composite when China initiated those huge reforms, which that's another one I want Aneeka to discuss at some point today. The Shanghai Composite went vertical, but now it's taken off 100, 150 points down to 3,300 or something on that index. Basically, since Trump exceeded Harris in early October. So some of the heat has come off the boil in Asian equities. One of the concepts that I jotted down as Kevin was speaking is, and I think it goes to this Stephen Tucson. Thank you for this question here about how inflationary are the tariffs. Has the bond market already de facto tightened in response to that? I think, Kevin, the backup on a 10-year T-note in this particular country is to the tune of like 90 basis points, again, in the last 6 to 8 weeks. Is that de facto tightening maybe something that will crush any inflationary impulses? And then also, as Kevin was speaking to the U.S. congressional majority for the GOP, it is razor thin. The GOP has a sizable lead in the Senate, several seats here, but in the House, it is very slim. So if you have any type of never Trumpers or someone against the MAGA agenda, maybe a lot of the Trump initiatives don't get pulled all the way through. Okay, Aneeka, Gupta, so much fodder for you to go. Take it any direction you want.
Yeah, Jeff, I think you've raised some really important points. And, coming back to the question we've received on the Q&A, our outlook for Europe and the UK has been going soft on the soft landing. And that's primarily because, even prior to Trump's re-election, the growth trajectory for Europe has been quite weak. And given Europe's international footing and its large dependence on international trade, the threat of tariffs coming in from the US does pose a very important challenge, and especially to the cyclical parts of the economy as well. So we expect growth to be downgraded to about 0.8% for 2025. We do, contrary to what the US is likely to experience, we do expect to see the disinflation process continue in Europe, and that's on the back of anemic growth, as well as services inflation, which still is quite high, begin to cool off as the labor market eases. And that's likely to put a lot of pressure on the ECB to cut rates, which is why we do expect to see, deposit rates in the Eurozone move all the way down to 1.75% by July. We don't expect them to move in increments of 50 basis points, and that's largely predicated on the fact that we expect the decline in growth to be a step-by-step process. We don't expect to see very sharp moves, which is why we expect to see them move in increments of 25 basis points. So given that we are likely to see those headwinds face Europe, it's going to be quite a challenging year for the European economy.
I think that's a fantastic point, actually. In our accompanying written commentary that we do with this webinar, this office hours presentation, we talked about, while similar to last year, we're coming into 2025 with central banks expected to cut rates essentially across the globe, maybe with an exception or two. We'll get to that in a second. But it's not a one size fits all. And I think the point, Aneeka, that you were just talking about here, if you're looking at it from the ECB side of the equation versus what's happening here in the US, right? I mean, how much have things changed here? The narrative, it's just incredible when you think about what has occurred here in the US in terms of the changing narrative with respect to the Fed. If you looked at mid-September, which is around the September Fed meeting, you had implied futures for Fed funds looking for 8 rate cuts, taking the Fed funds rate down to 2.8%. Now we're at just 3 more rate cuts, 3.8%. So it's amazing how things have changed, and that volatility quotient, how it's elevated, because as we've seen, when you're data dependent like this, the market's data dependent, and that's how you can get the volatility quotients, elevated as well. Jeff, you mentioned something about the increase in rates. The 10-year Treasury is up almost 90 basis points.
Is that the amount? Yeah, it's
where
something
it
like
was in mid-September. So, I mean, think about that, right? That is there a little bit of restraint being put on the economy, say in housing, that wasn't there before. I think it's a valid or a reasonable case to make. But, getting back to tariffs here, and then Nitesh, I want to come to you on this, is I went back and I looked at the tariffs from when, and inflation here, core inflation here in the US, from when Trump entered the White House in the first time to pre-COVID, right? You got to do everything pre-COVID, kind of to try and find a apples to apples comparison. And core inflation barely rose during the Trump administration, which I thought was interesting because that's when these tariffs first went into effect. Now, I know some of them are larger, maybe they're going to be more widespread this around, but there is a little bit of a playbook of what we did see during 2016 to pre-COVID in 2020. It's not as if Trump was never president before. And what is interesting, the first 2 years of the first Trump presidency, you also had full Republican control of both houses of Congress. So, Nitesh, we got a gold question. Let's kind of weave that into the equation as well. We're talking about tariffs, talking about inflation. Aneeka talking about perhaps some slowing in growth in the Eurozone. How is that working out with respect to gold? Is gold now going to be viewed as an area that could perhaps help portfolios in a tariff inflation trade, or we're not quite there yet?
Yeah, I think gold will continue to be that hedge against all the uncertainty, right? And then I think that's what we've got a lot ahead of us. Yes, we've seen Trump as a president before, but is Trump 2.0 going to be different to Trump 1? Probably, right? He's had 4 years to evolve, to gain a different perspective. He's got a different set of advisors around him. So there's still some uncertainty as to how he will implement the things that were in his policy campaign to when they actually become policies. So gold has always been a great asset for hedging uncertainty, around geopolitical risks, around financial risks, and around trade as well. Gold, if has been very valuable in past financial market shocks, and if a sudden lurch towards being protectionist becomes a shock to global growth, then gold could be favored in that direction. But also, if the trade restrictions become inflationary, and obviously that is an if, gold also favors in that environment. Gold is a good inflation protection instrument. It's been proven to be so for decades. We saw that especially in the late 70s and early 80s. And so gold would be the asset that's likely to be favored in a number of different market scenarios. But other commodities may not be as favored in an environment of lower trade. And historically, we've seen when global trade contracts, other cyclical commodities tend not to be as favored. But whether the trade restrictions that may come are going to be inflationary or not is just an open question. And I give an example just of last week we saw China actually cancel some of its export rebates for aluminium and copper companies. So China is offering these kind of rebates to exports to promote its exports, knowing what's to come down the road. It's offered a bit of diplomacy. It's taking away some of these subsidies because the tariffs may come down the road, and it could soften the blow of or reduce the risk of those tariffs by removing some of these subsidies. And makes sense to do so because you're offering a slug of money to these companies that are essentially going to face a tariff on the other end, rather than go through that convoluted process, take away that subsidy. That led to actually aluminium prices in Friday rising 8.5% intraday. So that is actually an inflationary force on aluminium prices in the global markets, but deflationary on the Chinese markets, because if you look at the aluminium that's traded in Shanghai, that's fallen. So it's a bit of a mixed picture depending on which part of the world you're looking at. But gold definitely looks like a favored asset from hedging against all this global uncertainty. And it's not just investors that are seeing gold in a much more favorable environment. Central banks are also loading up on a lot more gold these days as well to hedge against the uncertainty that's down the line.
Let's stay with commodities for a second. And Jeff, I know you've commented on this before, and obviously when people think about President Trump, and they're always drill, baby, drill. So let's talk energy for a little bit here in the US and globally. So, to the point where we did have a Trump 1.0 and waiting to see what Trump 2.0 is going to be, what did occur on the energy front here in the US during the 45th presidency? And Nitesh and Aneeka, how do you think if in fact the US does begin to open more things up, which I want to hear an opinion about as well, because there's been different opinions about we're producing enough as it is. It's just refining capabilities and whatnot. So let's go down the energy rabbit hole a little bit, Jeff. What did we see in the first go round?
Well, I think I read, what did I just read? That something like, for all the talk of a deregulatory regime in the United States from 16 to 20, that only 30% of the Obama administration's new regulations were rescinded by Trump 1.0. And there is this concept out there, Nitesh, whereby, and sometimes it's counterintuitive. You think, okay, this is going to be more friendly. This administration is more friendly to an S&P 500 energy type situation. Well, not if there's so much supply that you encounter a bear market. We've had a weak tape on both Brent and West Texas Intermediate for what, a good 90 days? How many days? Maybe 90 days? maybe 120 days. And so that is it's an ugly chart on Brent. What do you think, Nitesh?
Yeah. So, I mean, if you look at
I
US
can pull a
history,
Brent chart in the meantime while you're rolling.
yeah, you've seen actually the fastest oil growth under the Obama administration, the second fastest under the Trump 1.0, and the third fastest growth in oil supply under the Biden administration. So for all Biden's this, kind of anti-hydrocarbon talk, actually there's been a lot of growth in oil production. So some of the deregulation that we may see under Trump 2.0 may encourage extra oil production, but that's something that's already happening anyway. But the question is there enough financial incentive for oil companies to keep expanding oil production in a market that's oversupplied and oversupplied by a very large margin? The only reason right now that oil prices are hovering, in the, from Brent around 70 is because OPEC, the Organization of Petroleum Exporting Countries, is holding back on production. They're holding back on more than 3 million barrels per day. And that restraint on production is going to come to an end very soon. They were talking about unwinding some of that a couple of months ago. They keep delaying it, but the next delay is to the end of this month. And then afterwards, they're going to start to produce more. Now, they've been relatively sanguine on giving up market share to the US, and US is now the largest oil producer in the world by quite some margin, more than 2 million barrels per day. Under that kind of regime where at least somebody's talking about some restraint on the US, but if that's going to be unleashed, then it looks like OPEC will try to go for more market share and claw some of that back. So we're probably going to see an environment of relatively weak oil prices. The question is, are US oil companies willing to increase production when prices are this weak? I'm somewhat doubtful. And it goes back to your point, Jeff, that the refining capacity has to keep up with the crude capacity as well. And with if refining capacity isn't there and the refining margins aren't there, that's going to slow down as well. So I think that the slightly deregulated environment that we may see under Trump 2.0 will actually just be something that will help improve margins for oil companies rather than lead to a huge amount of new oil production. So in some ways, it's actually a much more favorable story for the oil equities than it is for oil, as a commodity. So right now, oil as a commodity has been doing relatively well because of the way you invest in oil futures. The fact that the oil curve is backward sloping, downward sloping, means that you're getting this kind of what we call a roll gain on the investment. So what we basically mean by that is when you're investing in a futures contract, as that future matures, it's getting closer and closer to spot, and you're getting an increase in price, and that's actually generated a nice source of return. So all investments have been, if you're investing in future markets, being quite flat, even though spot markets have fallen by more than 10%. But if OPEC destroy that backwardation in the curve, then that's actually going to weaken oil as an investment. So the equities, I think US oil equities are probably a better bet in this environment.
So Aneeka, with Aneeka, what I'll do is I'll try to do a control F inside the Global Edge. We wrote this 23-pager to see if there's any images that may corroborate whatever direction you're going to go next. So go ahead.
I was just going to, bring Aneeka back in here and talk about energy, what it means for China. China is kind of like the 800-pound gorilla in the room in this conversation, I think, as well, trying to figure out in terms of any further stimulus announcements, how about monetary policy there? Okay. And for investors, What should they be considering in Asia? Is India a better alternative, say, if you're looking at it from an EM perspective, um, with respect to equity? So, what are your thoughts there?
Mhm.
Yeah, I think the raft of measures we saw in the early half of September by China did provide a welcome boost to the market. It was clearly the measures that were announced on the monetary side, the counter-cyclical measures, the measures to support the equity market, alongside the measures to help the property market, um, were greatly welcomed. And we saw, as Jeff pointed out, a good tailwind to Chinese equities. Now, obviously, the big data print that everyone was waiting for was the follow through of further fiscal stimulus, and obviously that's where China has disappointed. So far, the
Mhm.
program that they announced by the Committee of the National People's Congress essentially laid out about 6 trillion yuan in new bonds over the next 3 years, and a further 4 trillion yuan in the previously announced bonds over the 5-year time frame. What the NPC was lacking was they didn't offer any additional announcements of measures to directly stimulate the domestic economy. And I think there was this pent up expectation, given the fact that Trump had been reelected, and now there was a greater expectation of tariffs being imposed on China, that China would actually come out with a much bigger than anticipated fiscal package. And clearly, it did not pan out that way. It looks like China wants to have a more careful view on before they actually come out with additional fiscal stimulus. They want to actually wait and see, how damaging these trade restrictions are likely to be before they actually bring out, the next stage of likely fiscal stimulus. So from that point of view, if you look at the data, we have seen some of the macroeconomic data improving. Um, the only problem is on the property market, the numbers still seem to be very, very lackluster. And that remains a really big drag for the European economy because uh, Europe, Europe from a revenue perspective relies the most on emerging markets. So China is right up there in terms of, one of the largest revenue generators, followed closely behind by the US. And given the fact that it has such a big international footprint, it's going to get pressure from the US alongside the fact that, China is on a recovering path, but it's a slow trajectory. That's likely to weigh on growth for Europe. But just looking at the opportunity and comparing China versus India, India is doing a lot better than China. Uh, that being said, we have seen, about 11 consecutive weeks of outflows by foreign investors from the Indian equity market. Um, but that could very much likely be as an after impact of Indian equities hitting record highs, them actually enjoying a very, very strong run. And now, the markets are in wait and watch mode of how the RBI is likely to tackle the situation on monetary policy, because we have a problem where inflation on the retail side remains very high. And that is holding back the RBI from further easing, and hence you have, financial conditions a lot more tighter. But from a growth perspective, we definitely, favor India to China.
And
Oh, go ahead, Kevin.
no, I was just, and Aneeka, what about the RBI? I mean, what should we be expecting from them going forward? We talked about it's not one size fits all, what we're finding out here. Where does India fit on the central bank part of the equation?
Well, I think right now they're very much on the wait and watch mode, and that's because what we're seeing in India is wholesale prices, which continue to remain quite high. And it's very different from what we see in developed market economies, where inflation, the bigger driver in inflation tends to be food prices, as opposed to the bigger driver inflation in developed markets, which tend to be from the services side. And hence, as we still haven't seen that begin to abate, that remains to be holding back the RBI from further easing. And obviously, now with the Fed, expectations for Fed's monetary policy path being a lot slower than previously anticipated, that is also holding back the RBI from easing further.
Jeff, do you see the question that just came in?
I saw that. Yes, and this person Lawson, who's asked, thank you, Lawson, for asking several questions. He's going to end up teeing Nitesh up for LNG, and Nitesh, when we get to that, will you tie that in? I imagine you will, with Russian natural gas and how all of that gaming out, receiving your LNG from the United States in a Trump administration to continental Europe ends up being critical. One of the things we wrote about in this piece, this is the piece that is in question, you can find it on the US website, soon to be on the European website, is the global edge. This is the four of us wrote this. In this, we referred to Modi's tenure in India as being Merkel-esque. I believe it was in this piece because Merkel, she was there for something like 16 years in Germany. And guess what? You wake up one day and you say, you know what? Narendra Modi has been around forever. It's something like 12 or 13 years for him. Now remember, and this is my feeling of things. Tell me if the three of you disagree. In the first Trump administration, Trump's foreign best friend was Shinzo Abe. In my opinion, Japan's Shinzo Abe, now deceased. Was his second best friend maybe Modi? I don't know. He was up there. When the press writes about these so-called strongmen type political leaders, it's Modi and Trump in the same sentence. And so when we talk about a 10% tariff that got boosted up to 20%, how much of that is just negotiation stage one, where we end up having the known quantity being something like maybe a 5% tariff on Indian goods, and the country that receives the brunt of it would be a Mexico or a China. Those are the two that really roll off of Trump's tongue the most, Mexico and China. Not so much others that hear it, the Germanys, Japans, and Indias of the world. Okay, let's take this, Lawson. It was very simple. It was the easiest question in the world. Thank you, Lawson. What about LNG? Nitesh.
Yeah, and I think you're right, Jeff. Let's put a bit of context here. So, natural gas markets around the world have traditionally been very fragmented, right? The US market is its own market. The European markets are their own market, Asian markets are their own market, and that's contrast to oil, mainly because oil is in a liquid form, it transports really easily without an additional cost, whereas gas, it has historically moved in larger volumes through pipelines. So countries that have close proximity to each other have a similar price. And have similar mechanisms, but when to ship natural gas, it needs to be cooled, so it needs to be liquefied, as in liquefied natural gas, and then sent abroad, and that extra processes adds cost. But world order had massively been changed in 2022 with the Russia-Ukraine war, and Europe, which was highly reliant on natural gas pipeline flows from Russia, got completely destroyed. So, we lost about close to 80% of natural gas pipeline flows into Western Europe after the war, and that's given a much larger role to liquefied natural gas. So Europe's supply of natural gas mainly comes through liquefied sources, and we've increased our reliance in European Union from Norway and a few other places around the world that can still go through a pipeline. But the direction of the pipeline flows have massively changed. We still actually have a little bit of pipeline flow that comes through from Russia via Ukraine, even through this war. So, there is, it's 10 to 20% that still comes from that source. But the contracts for those pipelines are actually going to come to an end at the end of December. So there is another slug of natural gas that will come off, and therefore Europe's reliance on LNG will increase even that much more. And in fact, just last week, a dispute between a Austrian natural energy company and Gazprom, Russia's big gas giant, saw that company OMV get an arbitrage ruling in its favor, and the OMV said, well, as Gazprom owes us 230 million, we're going to stop paying Gazprom for the gas and just take the gas into so that it gets cancelled out. So Gazprom said, yeah, okay, we're going to switch off the tap. So even last week, another slug of gas got turned off somewhat prematurely. So Europe's reliance on LNG has massively increased. The last 2 winters we've had in Europe were actually very mild by historical comparison. And so we didn't actually consume as much gas in those periods. If we get a normal winter or even a slightly colder winter, we could increase our gas demands from LNG even that much more. So, we're quite favorable on LNG demand coming from Europe. Asian demand for LNG has actually increased as well. A lot of gas demand, and US, which is a natural gas net exporter, will be part of that solution to provide more gas to the global markets. It's been building out a huge amount of infrastructure to export gas in the last few years, and still can't keep up with the demand that's coming from abroad. So we expect more LNG infrastructure build out, and that possibly will be accelerated under the new administration. But if you're looking at global prices for natural gas, actually US natural gas prices have been quite weak just because there's overproduction domestically and still not enough capacity to take it out into the global markets. If you look at Europe, we've had a very sharp rally in European natural gas prices recently, with some of these risks, being assessed, especially that cancellation of those contracts at the end of this year. So, European natural gas prices have actually been rallying pretty heavily on the back of this.
And I know, Kevin, we mentioned that the title of this is a monetary, but here's the reality. We came on here to talk monetary policy, but we have to talk fiscal policy. I mean, it's absolutely imperative here. And we have in the United States this initiative that I would say, Aneeka, I would say, Nitesh, is fully priced in that the U.S. corporate tax will go down to 15. So the disappointment would be if you can't get it from 21 down to 15, which is fully baked in and certainly in my expectations. Kevin, the other issue that, in my opinion, is fully baked in here in the United States, we have the state and local tax deduction. It's a major concept on your federal tax return. Those of us in high tax states, Kevin and I being 2 of us, we are relying on the promise that we've gotten. These are the so-called blue states that you would actually have the red administration helping out, where you would boost up the amount of state and local tax deductions that we can take back to what we used to be able to get in 2017. That's another thing. It's a consumer discretionary concept, Nitesh, that is on the table and perhaps fully baked in. Do we not show up and spend as much in 2025 as may have been hypothesized? Kevin, you've done a lot of work here on the U.S. budget deficit. What's the synopsis here?
Well, I think everyone needs to put in perspective. Red sweep, blue sweep, the expectation you were going to get an increase in the deficit, and then you get the intended swelling in Treasury supply. But what I find interesting, I've been doing this a long time. I'm not going to date myself, you guys, but I've been doing this for a while. And typically, budgets and attendant supply is secondary or tertiary. The primary driver is the macroeconomic numbers, inflation, the Fed. So, of course, you get a knee jerk reaction to the election, which, by the way, was quite interesting. The 10-year Treasury yield went up 20 basis points, just like it did in November of 2016. But then the dust settles because everybody realizes, to my point before, it's one thing to have these proposals out there. You actually have to get them passed into law. And that's where things take a different kind of spin because this is going to take time. It's not as if on day one, President-elect Trump can come in and do executive orders. He can change some of the things from the regulatory aspect. He can't do that from the legislative. It's a process, and it's a laborious process that takes time that we may not see what actually transpires until this time next year. But in the meantime, what's the Treasury market going to look at? It's going to look at how are the jobs numbers coming in? What are the inflation numbers doing? How's the Fed responding? And an interesting point on this front, October of last year to now, we have had two instances where the Treasury market has rallied by 100 basis points. In other words, yields coming down 100 basis points. You know what was occurring during that time frame? We were running $1.7 and $1.8 trillion baseline deficits that aren't going away. That is your baseline as you move forward from here. Unless there's some dramatic shift on the fiscal side, we all heard what Jeff was talking about taxes. Well, what about spending? That's the offset to this. But anyway, my point being, record Treasury supply, nearly $2 trillion baseline deficits, and you still saw the Treasury market rally. Why? Because both times it was thought the economy was finally cooling, the labor market was getting cold, inflation was coming down to 2%, Fed's going to cut rates aggressively. And we found out those rallies were not validated. It's exactly where we're at right now. Now, we talk about a new rate regime, and Aneeka, I want to go to you on this because I want to hear from the European side about this. Is that, the 10-year Treasury yield, how high can it go? To me, the more pertinent question is, will it go back to 360 where it was in mid-September? We can argue is 4.5, 475, 5. What's fair value? I would come in the 4.5 camp just to answer that kind of rhetorical question. But you don't go to 360 unless the data begins to falter again, that the inflation numbers, which have hit another one of those little bit of roadblocks like we saw earlier this year, start seeing further improvement in disinflation. So for here in the US, 10-year, 4.5, 475, somewhere in there is where we're going to gravitate towards for the better part of the next few months, and then we'll wait and see. But Aneeka, the 10-year Bund, the 10-year OAT, the 10-year BTP, what are we looking at in terms of sovereign yields in Europe? Is this going to be a kind of a thing where the U.S. rates stay elevated? Do you see a rally in Europe, or are they going to follow suit to what you think here is going to happen with treasuries?
I think they're going to decline, Kevin. When you think of fiscal, there is likely to be fiscal consolidation in Europe. But it's going to be a bumpy road. I mean, the first economy that comes to mind is Germany. On the day of the U.S. elections, we had Chancellor Olaf Scholz dismiss, the finance minister Lindner over concerns over economic policy. So what's really behind that is the well-known traffic light coalition, the Green, the Yellow and the Red Party have now split up, and now it looks like the key contention was you had the SPD and the Greens wanting a slightly more expansionary budget, north of about 9 billion euros, while the FDP was quite obstinate of sticking to the current debt brake, despite Germany's weakening condition. Now, we're likely to see snap elections, take place mid-February. And the current polls are indicating we're likely to have, the CDU party with the head Friedrich Merz have a coalition alongside either the SPD or we could even see the AfD. Now, that is actually quite a promising support and a promising tailwind for European economies. We could see a raft of reforms follow on from this new coalition that is likely to take place. We could see, strengthening of supply and demand, given the bigger room for public investment. We could see lowering of business taxes. We could even see trimming of welfare and pension benefits, and a more disciplined approach to immigration. So I think, if you flash back on the performance of equities, Germany, and in particular the DAX, has been a ray of hope because the DAX has, outperformed leading European indices by north of 9.2% in 2024. And that's been owing to the fact that Germany relies so heavily on external markets. And now that we could see a scenario where we finally get the loosening of the debt brake, that could be more stimulatory, for the German economy.
Jeff, you're not getting off the hook here. Question came in, and we'll take it to Europe. We'll take it to the U.S. Given our 2025 outlook, growth or value?
Growth or value in 25? Well, first off, that's the chart of the DAX that I just flashed up on the screen. Well, there are several concepts that I think are pretty topical in terms of just the changing political regime here in the United States and how it affects the market. The next statement out of my mouth is, sadly, it's consensus, though, Aneeka, that there will be this M&A revival, and it benefits the big, major, large cap U.S. banks. Surprise, surprise. The sad thing is everybody else is saying it. I'm saying it, but it's no secret sauce. Everybody is well aware of that theme. You saw the Morgan Stanleys of the world pop in reaction to the Trump victory. The theory would be that groups like the Environmental Protection Agency would have to step back, for example, and the regulatory regime would allow for this vibrancy, and then the beneficiary would be financials. Now, financials tend to populate groups like the S&P 500 value, much more so than the S&P 500 growth. So that's a notable benefit. But as Nitesh was pointing out, you also have energy over there in value, and you have this somewhat counterintuitive concept where a pro-energy, pro-oil and gas president may be bearish because maybe we're swimming in this stuff. Something else in terms of, it's not necessarily growth versus value, but just screens in equities. Remember, an issue here in the United States was there was no such thing as a buyback tax. That did not exist. There was a 1% buyback tax, and then it was Joe Biden and then into Kamala Harris, where the desired number, it's kind of like Kevin, the first number you lay out, you don't expect to actually get it done, was taking it from 1 to 4%. And then you saw a lot of relief here among, call them buybackers, for the lack of a better term, on account of it is back to only 1% and now baked in. So I think that continues to be a thematic concept. Oftentimes, when you have a company who's buying back stock, it's highly correlated with the company's marginal propensity to pay a dividend, because you announce those together. We are our 25-cent dividend, we're raising it to 27 cents, and we're expanding our buyback program by X billion dollars, that type of thing. So those are a few that are on the table. Let's see if Nitesh or Aneeka want to piggyback on anything.
Yeah, I would definitely agree. I think, large cap value in the US stands to benefit with the, theme largely of deregulation. And obviously, Nitesh cited how the energy companies benefit from those higher margins. That's also likely to aid the energy sector. But, one would imagine with technology being one of the biggest drivers for earnings, why would we still see a lead for value, and I think that's where valuations come into play. For the tech sector, given the fact that we're likely to see bond yields trending higher, that's going to pose a greater risk on the upside to valuations, with rates remaining higher for longer.
Along those lines, Nitesh, well, you're going off mute. What do you have, Nitesh?
No, I was just going to extend the comment Kevin made earlier on the higher bond yields. That's obviously something that's come as a knee-jerk reaction from the market. Whether we go back to something lower is yet to be seen. But one thing that's pressured is gold. That's been a headwind for gold, as has been the stronger dollar for some time. And stronger dollar is possibly a headwind for all commodities.
Here's the dollar index. Here's the dollar index on the screen. Continue.
Yeah, and you can see it from there. 5% in a month. It's a particularly heavy headwind there. But gold has held off relatively strong even with those headwinds. Should some of these headwinds start to ease, I think we could see gold prices rally considerably higher. Should some of these headwinds start to come off, like we saw back in August and September, everything in those 2 months was in line for gold. Gold could go massively higher.
Aneeka, are we going to parity on the euro?
I think so. I think we're going to parity, and I think we're likely to stay there. We're not going to get a very quick knee-jerk reaction, from that move, and that's largely predicated on the fact that the Fed looks likely to, the expectations for the Fed are to, start to reduce that sharp pace of rate cuts in 2025. And in sharp contrast, we have the ECB accelerating their pace of rate cuts. And that's largely going to be contingent on the growth differentials. Europe's growth is likely to suffer, while the US is likely to reign supreme. And that's being reflected, since Trump has been reelected, and that's pressuring the euro-dollar FX rate.
And as we wrap up the call, other than the global edge, which everybody's going to immediately start to read right after the end of this call, what other material has been published by the European business that they should go and find?
I'll start off with a few things. We publish a monthly piece on gold. So if you want to keep up to date with what's happening on the gold markets, you've got a monthly piece there. We also do quarterly forecasts for gold and silver. They're on the website and regularly published. We also do a monthly wrap-up of everything commodity related in a commodity monthly monitor. We do tons of blogs, and I can't go through the full list, otherwise I'll keep you here for the next hour. But they're the sort of things that we're publishing very frequently on the commodity side, and I'll let Aneeka talk through some of the pertinent material on the equity side.
Yeah, we've done the repercussions of Trump coming to power and the implications on global financial markets. So that's an interesting one to keep an eye out on. We've also done quite a few blogs on the impact on Japan, how we're expected to see emerging markets trade given the re-election of Trump. So those are some of the interesting blogs to keep an eye out on.
And here in the United States, you could do things like find Kevin and I writing the Minds on the Markets piece. This morning's piece is about Japanese M&A, the Siegel commentary, Kevin's podcast, which is called Basis Points, Kevin and I on YouTube, Twitter, which I guess these days is called X, and of course the U.S. Market Insights and the U.S. blogs. There's a lot of written and audio-visual material on the U.S. website. Kevin, wrap the call.
Yeah, I think this was great. Hopefully everybody got a nice global sense of our thoughts here at Wisdom Tree, thought leaders here in the U.S. and on the other side of the Atlantic. So that's a wrap from here, everybody. Have a great rest of the week. Have a great holiday season.